Hello folks, I'm Rodney Hathaway, Chief Investment Officer at Waukesha State Bank Wealth Management. And welcome to our May edition of Market Chats. Today, I want to share a perspective on the Federal Reserve, how its role has evolved over time, and why that matters for inflation, markets, and your portfolio. Before the Federal Reserve was created in 1913, inflation wasn't a constant feature of the economy. Prices would rise during wars, but in normal periods, they often fell slightly as productivity improved. Since the Fed's creation, however, inflation has been a persistent force. Over time, the US dollar has lost a significant amount of purchasing power. That shift largely reflects how monetary policy, how much money is created, and how interest rates are set, has changed the system. The Fed has had both successes and mistakes. In the 1970s, too much money in the system led to high inflation. In the early 1980s, the Fed corrected that, but at the cost of a recession. In the early 2000s, rates stayed too low for too long, contributing to the housing bubble and financial crisis. After that crisis, and again during COVID, the Fed used a policy called quantitative easing, or QE, which essentially injected large amounts of money into the financial system. QE significantly changed how the financial system works. Instead of markets setting interest rates, naturally, the Fed became a major buyer of government bonds, helping keep rates low. That also increased bank reserves and the overall money supply. In the years after 2008, that money largely stayed within the banking system. But during COVID, money supply grew rapidly, and that helped contribute to the inflation we experienced more recently. Right now, inflation pressures appear more contained than headlines might suggest. Money supply growth has slowed, and housing, which is a major driver of inflation, is not accelerating significantly. Markets are debating whether the Fed will raise or cut rates next, but the bigger question is whether policy will shift in a more disciplined direction going forward. For investors, the key takeaway is this. The Fed has a powerful influence on markets and inflation, but its policies can swing over time. Staying focused on long-term fundamentals, diversification, and a disciplined investment strategy remains the best way to navigate those changes. Thank you for tuning in. Please reach out to one of our advisors if you would like to discuss this topic further, and we look forward to our chat with you next month.